All right, we're live. Welcome to the live stream. Be the boss of your money. Couple of things to go over this week. Two big earnings announcements: Apple, Amazon Thursday after the close. We also have non-farm payrolls for July. That's the biggest number that the Fed looks at is employment. We're all asking the same thing: is employment going to stay strong? Are we going to avoid a recession because the Fed's raising rates to slow down the economy? Do we stick with the soft landing possibility? Stock market rallied pretty good in July. The S&P 500, the Nasdaq, 5 months in a row, both those averages are up. The Dow saw a 13-day win streak. That is the first time that's happened since like 1987 or 86. And investors are pretty pumped up in the market. Now we have to start thinking, your investors, near term anyway, are they getting a little complacent? The whole rally is predicated on the thought that we don't go into a recession and the Fed could stop raising rates. But now that we're here, what's next to keep the party going? So we need to discuss a couple of things. Yellow, the big trucking company, is kaput. I don't think it's a big deal for the economy. These people will find jobs. There is a massive shortage of truckers and trucks and infrastructure for that. So I think we're going to be fine. And those, dividend safety check. You have to know if your dividend is safe, because people talk about dividend stocks. They talk about the yield. Like that's not the only thing to buy a stock for. So we have to check the safety of your dividend. So let's take a quick roll of the intro, and I'm going to be off in about 5 minutes because I have to be somewhere soon. So let's make it a quick one. Here we go. Late afternoon coffee. No, it does not keep me up. All right. Couple quick things. Markets had turned out to be an okay day, pretty decent. Major averages were up. We're going to take it to the tape right now. Let's go take it to the tape, pop myself up in the corner. Boom, here I am. All right, so you see the Dow up 100, Nasdaq up 29. S&P up fractionally, up 6, barely up, but an up day is an up day. Gold breaking through 2,000. So that, I think, is somewhat significant. I think that could be partly due to inflation expectations starting to actually rise a little bit, because you see the price of oil going up, price of gasoline and other commodities are starting to really look like they bottomed out, and they're starting to pick up some buying action, some gains, some strength, which is not really what we want to see for the inflation complex. 10-year yield was off ever so marginally. It's basically a non-event. The VIX is still 13. So let's go through these one by one. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Okay, so just have to get that disclaimer out of the way when people come up to me and they talk to me. They go, "Hey, Mitch, by the way, did you know that you can't invest directly into an index?" And I just want to say I ran into a lot of friends this weekend at the beach, out east, everywhere. And people are saying to me, "Hey, I watch your live stream. I watch your videos. Great job." And I want you to know I thank you so much for the positive encouragement. That was a really meaningful thing. I saw Jeff yesterday with his wife, Beth, at Robert Moses. That was just really awesome. Just people coming up to me saying, I see your videos, I watch your live stream. And I realize not everybody can watch the live stream while it's live. You're watching the replay. It's on your timeline, my timeline. I appreciate that. If you wouldn't mind, give me a thumbs up or a heart or whatever reaction is available to you in which platform you're watching on. I stream to Facebook, LinkedIn, YouTube, and Twitter. I don't know if I'm going to be streaming to Threads yet. They don't allow live streaming yet on their platform, unless you probably do it directly through them, kind of like Instagram. So it doesn't really work for me. So that's what I'm looking at. Thank you very much, guys. I really appreciate it. If you give me a thumbs up, it spreads the good word of the work we're doing here. If you have any questions, you ask me in the comments. I will see those. Words of encouragement or hello are always appreciated, or just share with me your favorite emoji, and that would be cool. And when we start getting the questions, it gets more fun. It also helps the algorithms, right? It helps push the show out a little bit. But let's do this first. Let's take a look at the markets here, which we did. Is this meaningful today? The VIX is below 13. The VIX is a fear gauge. It's basically if investors are worried about the stock market having a sharp leg lower. That's what that's for. And when investors are starting to pay more money for derivatives products like options to hedge their portfolios, they're worried. They don't want to get out of the market, but they want to buy derivatives that could help protect their portfolios. Investors are not really excited about paying to hedge their portfolios, which tells you that the large investors anyway, they're not really worried about the stock market taking a near-term dip. But we have to talk about some of the negativity out there. And I think it's worth exploring. I don't just dismiss it. Oh, people are negative. Who cares? There's always a reason to be concerned. We never want to be complacent. But if your time horizon is long enough, you don't really have to worry about the short-term stuff. If you want to really be a lazy investor, just don't look at this. Just keep investing for the next 20, 30 years. And I think that will actually be a very good strategy. Don't overthink it. Don't overdo it. Don't try to manipulate the stocks that you have in your mutual funds and time all this stuff. Not that you can't time it, but the odds are so low that an individual investor could successfully time the market over and over and over. It's so low that you're most likely to make mistakes and it won't be worth it for you. You might time it one time. You might get it right here and there. But all you have to do is get it wrong once to wipe out all the gains from all the times you got it right, which is what makes timing the market so difficult to do. Not against it. And if you want to try with a portion of your assets, that's perfectly fine. The better thing would be to have a strategy. And if you want to use a strategy that could help you add discipline to your portfolio, you could use buy limit orders, below the market buy limit orders for the stocks or funds that you want to buy. You can't do this with an open-ended mutual fund, but you could do this with an exchange-traded fund. Let's say an exchange-traded fund is $40 a share, and you want to buy a little bit more if it dips 5%. You maybe want to buy 30 shares if it dips 5%. You could put a limit order in to buy more of those shares if it dips 5%. And the limit order will be good till canceled. Limit order will be good generally for a year. After a year, they just basically go away. On the other hand, if your stocks are up, there's two things you could do if you don't want to get into market timing. The first one is you could rebalance your account. You have too much in stocks, rebalance it, meaning you get your stock exposure lower to where you originally planned to have it, and you put that extra money into cash and bonds to bring those allocations up to where you originally planned. When you do that, you're managing your portfolio based on a risk profile, and you're letting the upside take care of itself. When you're trying to time the market, move the money around, in and out, darting in and out for this winner to that winner, what you're doing is you're trying to lead with returns and not managing the risk. So I'm giving you a strategy here with these limit orders. So if a stock is up a lot, you could sell some, and you could maybe put a limit that chases the stock up, okay? And as the stock goes higher, your limit order goes up with it. But if the stock backs off, your limit order gets hit, and you protect your profits with a trailing stop order. So those are two very helpful tools that you could use. You could give a leeway in terms of what the price would be. They're not perfect. Sometimes the stock trades right through a limit order, and you wind up not getting sold or getting bought on your order. That's a chance you have to take. And if you want to talk more about that, you can reach out to me and we'll talk strategy. You can check me out on my website, Client First Strategy. My partner and I are ready to handle your calls and to help you with your planning and investment needs. And that's about it for that. Okay. So you could rebalance, you could use limit orders, and Rita is out there. Hey girl, how are you? So nice to hear from you. We need to chat. Let's talk about dividend safety, because I saw an article today about utility stocks and the utilities ETF yielding over 5%. Utilities is one of the major 11 sectors of the economy. And you could take, you take the stock market and you divide it. Like there's industrial stocks, there's utility stocks, there's financial stocks, healthcare, staples, consumer discretionary, energy, okay, technology, communications, financials. Did I leave any out? Materials. So you take a look at a stock like Dominion Resources. I'll put you back on the screen. Okay, we take a look at Dominion Resources, a utility, well-known utility stock. It's in the utilities average, the Dow Jones Utilities average, and it pays a dividend of just about 5%. The dividend is $2.67 a share. So $2.67 divided by where the stock closed, which is up here, $53.55, is 4.99%. Stock is down 12%, a little over 12% this year. And you like dividends because you are trying to manage your money in retirement so that you can live off of dividends and interest. You don't have to touch the principal because you want the principal to last as long as possible. But here's the risk with just shopping for a dividend. The earnings per share is $1.44. The dividend is $2.67. The problem, the earnings, the problem with this is that the earnings don't cover the dividend. So either you expect this company to make a lot more money or you expect the dividend to be cut. One is more likely than the other. And my sense is it's a lot easier to cut the dividend. These companies have management who they have to protect the company, not the shareholders' dividend. And I remember years back, I was on this show talking about AT&T. Guys, I said, I think AT&T is going to cut the dividend. It's not sustainable. The earnings are not enough to pay for the dividend. They're much lower than the dividend. And, they've been doing that for years. And people said, you're crazy. AT&T will never cut the dividend. But then what happened? AT&T cut the dividend. The stock went from like 36, 38 down to 14 where it is now. AT&T has been a losing stock, I'm going to say, for at least the last 20 years. And even though you collected a dividend, it still doesn't even come close to making up for the loss of capital in the price of the stock and the opportunity cost of having just been in an S&P 500 index fund. So you need to take a look at the dividend. Let's take a look at some of the things here like GE. GE, this is just a month. Okay, that's not really what I wanted to show you, but let me just go here back. Okay, that's not what I wanted to show you. I'm going to make the screen a little smaller, and then I'm going to put you on it, okay? Here, let me put you on like this. All right. GE in the last month went from here. What is this price? Let's say about 110 to 114, up over 3%. Okay, but still, GE is moving, trading near highs. Stock is 114, the high is 117. And then you take a look at Boeing in the last month. Boeing has gone from about 210 to almost 240. That's a big move for a company the size of Boeing. And then you take a look at, do I have United Rentals here? United Rentals was up $18 today. That's a big move. United Rentals is a very cyclical stock. When you see big construction crews using big, heavy industrial machinery, heavy machinery, cranes, things like that, you could pretty much bet that that heavy machinery is rented from United it's rented from United Rentals. United Rentals is a very cyclical stock. So the market rallied, the Dow rallied, and the Dow, we talked about this getting a lot more respect because even though it's only 30 stocks, in my opinion, it's become more representative of the U.S. economy than the S&P 500, even though that has 500 companies in it. Because the S&P 500 is so tech-centric. It's basically a tech fund. So if you want a tech fund, you could buy the S&P 500. I guess the NASDAQ 100 is more skewed toward tech, but you know what I mean? It's a very heavy influence of tech. Probably if you consider communications as tech, like Netflix and Facebook, which are considered, they're not even in the S&P technology sector, they're in the communication sector. If you add those in, then you're looking probably about 45% of the S&P 500 is probably tech, right? So that's what we have to look at. So technology stocks have rallied, but so have other sectors. So this rally is starting to broaden out, but there are some bears who are saying this about things we need to watch out for. There's always going to be a bear. There's always something. There's always something to worry about. There's always a wall of worry to climb, and there's always somebody saying, "Yeah, but this, and that." And a lot. I think it's easier to scare people than it is to make people feel confident. That's just the way it is. It's easier to feel scared than to feel confident. Just you go through your daily life, and you're like, meeting really confident people is not common, but meeting people who are afraid of things is very common. So it's just, I guess it's the way we're wired as human beings. You have to work on yourself. You've got to become confident. You got to work it, baby. You got to work it, man. You got to work. Oh, that was so cheesy. I just punched the microphone. So, but the bears say the yield curve is inverted. Now we've been talking about this for over a year. So what is the inverted yield curve? If you buy a 3-month T-bill, it should have a lower yield, a lower interest rate than, let's say, a 10-year treasury bond. Because 10 years, you're going out a long time. You've got to get a higher rate to tie up your money for that long. Take the risk that interest rates don't go higher. Yet the 10-year yield is actually way below the 3-month T-bill yield. And the reason is because the 3-month T-bill, the 1-year T-bill, the 6-month, the 2-year, they track what the Fed does in terms of when the Fed raises the federal funds rate. But the 10-year yield is down because people expect the economy to slow down, for inflation to come down, possibly a recession. So people crowd into the 10-year treasury at the same time, and they buy it because it's their hedge against a recession. It's a place to be. Investors are looking for stability. They're looking for safety. They're looking for a place to be if inflation comes down and we go into a recession. So they buy the 10-year bond. So that's telling you that investors are worried, and it's hard for companies to plan on a bright future because of that. It's an indication of low confidence in the future of the U.S. economy. But there are some things that skew it. For example, about 30% of all treasuries are held by the Fed because the Fed did a massive amount of bond buying called quantitative easing. So that's helped skew the picture. And if the Fed wanted to sell a lot of bonds, you would see long-term interest rates go up pretty quickly, and that would probably bring down low, short-term interest rates. Why? Because it would hurt the economy so badly that the Fed would have to go into rate cutting mode. So I don't want to make too big of a deal about interest rates being too high. What I want to say is I think the market is more interested in stable rates as opposed to rising rates. Okay, we need to make plans. We need to plan expansions, build plants, buy machinery, hire labor. We need to do all these things, but we need a stable interest rate environment to do that. It's not necessarily lower rates. It's really necessarily stable rates. And we had stable rates for such a long time until about a year and a half ago. So we will find out what the Fed does for its next move. But Friday's employment figures will be a very big tell. That's for the July figures. And the August employment figures will come out early September ahead of the next Fed meeting. So we've got a couple of big statistics to get through before we get to the next Fed meeting. And the Fed's watching employment very closely to see how that's affected. If inflation comes down and the economy slows down, the Fed is not lowering interest rates. If employment starts to go down, unemployment starts to go up, that's what's going to get the Fed's attention. That's what's going to get the attention of investors, and that will determine the Fed's next move. All right, I've said enough. Have a great day. I'll see you tomorrow, and thank you so much for your time.